Uh, it's an unfortunate tragedy that's happened. But when it comes to markets, these geopolitical events tend to make a pretty big noise on the first couple of days, but then it tends to slow down and the effects start to wear off. So I think from a market point of view, it will continually fixated on how the Federal Reserve is doing, how U.S. inflation is doing, and I think those things are going to be driving markets going forward.
Okay, fair point. Sean, also, while we have you, the view in-house at the moment is that investors, traders need to start positioning again for a post-summer US slowdown with defensive positions. How much is that? How much of that is based on the commentary that we have heard from the US Federal Reserve in the last week?
Yeah, I think markets tend to do well, especially going into the summer with this lower inflation numbers coming through, and we're in a bit of a Goldilocks moment. But as you mentioned, usually when you get lower inflation numbers like we saw, it's followed immediately by lower U.S. growth numbers. And I think that's what markets need to start to position for. And so instead of a higher stock market that we're seeing now, I think you have to be positioned more defensively, which is things like receiving US dollar interest rates at the short end, 1 year, 2 year, and then defensive quality things like the Japanese yen start to perform again.